In this session, we will be having a look at the idea of double entry bookkeeping. Now, double entry bookkeeping is the process of recording our monetary transactions. This really extends upon the ideas and principles that we saw in our previous sessions, particularly when we were looking at the accounting equation and also the dual effect and the separate entity or business entity principles. Now, remember what we said in the previous sessions. Every transaction must have an equal and opposite effect. Remember, like those scales. Okay. Now, in order to record that dual effect, we use the accounting equation. Assets must equal capital plus liabilities. And we said every time we do a transaction, we're going to record the dual effect and see the effect on the accounting equation. And for every transaction, we essentially updated the accounting equation as we went along. Now, the problem with that is it can get quite time consuming. If you imagine most commercial businesses, they would have thousands and thousands of transactions on a daily basis. Imagine if you were the accountant or the bookkeeper at that business having to rewrite the accounting equation over and over again just to record those dual effect transactions. Now, in reality, we don't have an awful lot of time to do that. So what we do is we use double entry bookkeeping instead. And that's really going to extend our principles of the dual effect and the business entity principle a little bit further. Now, let's have a look at what double entry bookkeeping is by definition. Well, double entry bookkeeping by definition is the recording of monetary transactions of a business. I'm just going to say that again. Double entry bookkeeping is the recording of monetary transactions of a business. Okay, so we're going to use double entry bookkeeping instead of the accounting equation from now on. Now, when we record transactions, what we're going to record them on is our ledger accounts. Now, ledger accounts are going to assist us in preparing our financial statements. Remember that we said that they were the statement of comprehensive income and the statement of financial position. Now, essentially, we're going to have this idea of an account or a ledger account for every individual type of asset, liability, and also our capital, but also items that will go into our statement of comprehensive income, namely income and expenses. Remember, we have 5 categories in our financial statements, or 5 different elements to our financial statements. Okay. Now, for each ledger account that we open up, it's essentially going to have 2 sides, a debit side on the left and a credit side on the right. So let's have a look and see what these ledger accounts effectively look like. Now, you can see there a ledger account almost looks like a T. Okay, T account, we sometimes refer to that. Long line across the top and obviously a line in the middle, as you can see in your notes. Now, you can see on the left-hand side of the middle line, we have debit on the top. Now, debit is on the left-hand side. And sometimes we refer to that as DR. Okay, it's just shortened, DR. On the right-hand side, that is the credit side. And we can see that that's abbreviated to CR. Now, at the top of the ledger account, we can see that we're going to have the name of the account. So the name of every single type of asset, liability, capital, income, and expense. Okay, so for example, we could have the bank account to record all our cash at bank transactions. We'd have a capital account to record the amounts invested in the business by the owner. We could also have a loan liability account to record the fact that the business now owes money to the bank, so on and so forth. But for every different type of asset, liability, etc., they're going to have their own ledger accounts with a debit and credit side. Now, what we have within the ledger account on each side is 3 columns. the date column, the narrative column, and then the amount of the transaction expressed in dollars. Okay, so the monetary value. And the same columns would still happen on the right-hand side, the credit side. Date, narrative, and then an amount in dollars. Now, in order to be able to prepare these ledger accounts, we have to think about some key fundamental principles. So let's take a look at them. The first principle of ledger accounts is that every transaction must have an equal and opposite effect. Okay? That really is the dual effect principle. And remember, we learnt that dual effect principle in our previous sessions. Now, what we also have to do to record this dual effect is actually give that dual effect either side of the transaction a debit or a credit. Okay? So to record this dual effect, every debit entry on the left must have a corresponding credit entry on the right. So every debit must have an equal and opposite credit. So that dual effect principle that we saw will still be the same. All we've got to learn now is what is a debit and what is a credit entry. So let's have a look at then how we would learn what is a debit and what is a credit. And in order to be able to do that, I have a little mnemonic. Okay, I use the term dead click. Okay, dead click. D-E-A-D-C-L-I-C. Dead click. Okay. So, dead, D-E-A-D, appears on the left-hand side of the ledger account, on the debit side. Now remember, debits are on the left, credits are on the right. And in the UK, we drive on the left-hand side. So we drive on the left, but if we drive on the right-hand side, we crash on the right. Drive on the left, crash on the right. That's how I like to remember what a debit and what a credit is, or which side it goes on. Anyway, so on the debit side then, the left-hand side, that's the first D in dead click. And on the debit side, any types of expense, assets, or owner's drawings will be a debit entry into those accounts. Now be careful. You debit expenses, assets and drawings only if you are increasing those accounts. So if you have an increase of an asset of cash at bank, for example, well, that would be an increase in an asset and therefore it would be a debit entry. This mnemonic only works if you are increasing those different types of account. That's really important to remember. So on the debit side then, expenses. Now an increase to an expense would go to your statement of comprehensive income. Remember to establish the profit or loss for the business for the year. Assets, well, they appear in your statement of financial position at the year-end date. And finally then, drawings. Drawings are money taken out of the business by the owner, essentially a reduction in the owner's capital. Well, that would always appear in the statement of financial position as well. So then, for increasing an asset, an expense or drawings, that would be on the debit side, that would be the dead. Now remember, this whole mnemonic is dead click. So the C-L-I-C. Well, the first C obviously stands for credit on the right-hand side. And if we're increasing an account, that's a liability, income or capital, well then that would go onto the credit side. So liabilities, income and capital, if we are increasing those accounts, that would be a credit entry. So with liabilities then, remember that they appear in the statement of financial position, everything that the business owes. Income appears in your statement of comprehensive income. Effectively, it increases your profits. Capital is the amounts invested by the owners in the business, and capital would also appear in the statement of financial position as well. Okay, so dead click, debit on the left, credit on the right, and remember, dead click only works if you are increasing those different types of accounts. Now, you can see then that, okay, that's how we increase the accounts. Well, what about if we decrease them? Well, if you are increasing, let's say, an asset of cash, then that would be a debit entry. But if you're decreasing your asset of cash, let's say to purchase a building, let's say, well, a decrease in an asset would appear on the opposite side of the ledger account, the credit side. So an increase on an asset is a debit entry. If you are decreasing an asset, it would be a credit entry, the opposite. All right, so make sure that you note that to decrease all these different types of accounts, the debits and credits will be reversed. But if you know how to increase an account, then the decrease would be the opposite. And that's why we remember dead click. Now we're going to use this dead click in our next example, which will be in our next session.